Welcome to the Big Four Accounting Firms podcast, brought to you by big4accountingfirms.com. I want to start today's podcast by thanking you for listening and helping grow this podcast. I'd really appreciate it if you could keep helping us grow by sharing this podcast with a friend. Also, make sure to rate us on iTunes when you get a chance and subscribe to this podcast on whatever platform you choose. Today, we are going to be covering the KPMG controversy surrounding their audit of Wells Fargo. As you may recall, Elizabeth Warren and Edward Markey, both senators, have previously written to KPMG to figure out why they did not uncover the Wells Fargo fraud earlier. Well, Elizabeth Warren and Ed Markey received that response in November, and now they want the PCAOB to investigate what happened. This is most likely because Wells Fargo easily ratified KPMG as their independent auditor as part of their annual proxy process in 2017. Elizabeth Warren was hoping that Wells Fargo would fire KPMG, similar to what they did to their CEO. Now that they have not fired KPMG, she is out for her pound of flesh. The reason that Warren and others have questioned this is because Wells Fargo committed tons of fraud for years by setting up fake accounts for their clients. What resulted is that the Consumer Financial Protection Bureau fined Wells Fargo $100 million for creating 1.5 million deposit accounts and over 500,000 credit card accounts. These accounts were not authorized by customers. What KPMG contends in their response is that they were aware of the matter, but that they were able to get comfortable that it did not materially impact the financial statements or the controls over those financial statements. Now, I'm not too sure how KPMG reached the conclusion because $100 million is a pretty significant financial impact to me. Additionally, there is no way that KPMG could have known that amount would have only been $100 million. It could have ranged from anywhere from 20 to 30 million to hundreds more million. How did they know it was going to be 100 million? And how did they know that it wasn't going to materially impact the financial statements? In my opinion, KPMG has handled this whole thing poorly. There's no doubt that they should have done more when they figured this out. They should have also resigned just for branding purposes alone. This account is too high risk if you have executives involved in a scheme to defraud customers. How can you say that the controls over the financial statements are still there? I don't blame Lynn Doty, who is the CEO of KPMG US. She was the one that responded in the KPMG letter. I don't blame her because she's in this accountant mind frame. Sometimes these big four accountants just get tunnel vision and only see the checklists and the templates for their audit programs. If you come away from everything that Wells Fargo did during this time frame thinking that you are all good from a controls perspective, you are living in another world. This is exactly what Sarbanes-Oxley was meant to prevent. It was meant to prevent misconduct by executives and prevent their big four auditors from just sitting there on the sidelines. It is obvious to see that there is still a conflict of interest here. It is obvious that KPMG doesn't want to lose the account because it is one of their biggest clients. It would be a material impact to their financial statements to lose Wells Fargo as a client. And this is where Sarbanes-Oxley falls short, because what happens when these firms who get tens of millions of dollars from these clients find something wrong with their clients? Are they supposed to resign? Can they whistleblow? Probably not. There's confidentiality in their contracts. And also, they can't afford to lose that client. So they're not going to do things that would risk the relationship. This is something that Warren and others are going to need to address. Her just barking up the PCAOB's tree and barking up KPMG's tree is not going to fix this. She always does things to hit the headlines. She doesn't try to fix the root problem. The root problem here is that these big four auditors are conflicted out because they make tens of millions of dollars from these clients and they're not going to risk that money. And additionally, the clients force them to keep things quiet through confidentiality clauses. Also, as a big four auditor, if you see that authorities are already doing something, what more can you possibly do? KPMG has filed their response and Elizabeth Warren is not satisfied. Now the PCAOB is on the clock. Let's see what their responses are to Elizabeth Warren's letter. They have to answer the following questions. Question 1. Has the PCAOB conducted any review of KPMG's conclusion with regard to its conclusions about Wells Fargo's financial reporting from 2011 to 2015? If so, what were the findings of these reviews? Question 2. In response to the Wells Fargo crisis, has the PCAOB established any updated rules or guidance to help auditors determine whether actions undertaken by employees of public companies result in incorrect financial reporting or undermine the integrity of financial reporting. Question 3. In the case of Wells Fargo, KPMG indicated that the size of the fraudulent accounts or the fines imposed by the CFPB and other regulators for the fraudulent accounts was the sole factor affecting the integrity of the financial reporting. KPMG ignored factors such as the impact of the fraud on the company's stock price, the reputational harm to the firm, and the flawed corporate structure that independent board members identified as a root cause of the scandal. Were these decisions by KPMG appropriate and consistent with PCAOB rules and guidance? Question 4. KPMG did not publicly report the widespread fraud, despite now acknowledging that its auditors were aware of it prior to the 2016 settlement. Do PCAOB rules or guidance indicate whether auditors have responsibility to publicly report or otherwise act on their knowledge of illegal or inappropriate activity by clients? Those are the 4 questions that she wants the PCAOB to answer. And I guarantee you that they're going to say KPMG should have done more, but they acted within the guidance, because that's what KPMG did. And that's why Lynn Doty responded in her letter the way she did. Lynn Doty didn't just sit down at her computer, pop open her Outlook, and start typing the response herself. No, she went there, she asked the partners of Wells Fargo what they did, then she got all that information and she ran it past her legal team and they drafted the response for her. And at the end of her response, she believes that the financial statements were correct, that what KPMG did to audit was correct. And she's probably right. What they did is perfectly within guidance. And that's the problem. And that's what Elizabeth Warren doesn't understand about auditing. Auditing is reasonable assurance. It's not, I'm the overall watchdog to this company. No, I preside over their financial statements and how their financial statements are prepared. I don't pay attention to these corrupt individuals over here and try to prevent corruption, because if that was the case, then they should charge more money. Is this the right answer? Probably not, but it's what the auditing industry is today. Now, I think Lynn Doty's response is not good enough. She can't just sit there and say that what KPMG did was correct. That's not correct. They should have done more. They should have resigned or raised the flag to somebody else, because even if what you're doing is correct inside of your contract, you have to assess it in the bigger picture. And it's funny because if you work at KPMG or any of these other big 4 firms, they make you take a million trainings over the side effects of ethics and values and independence. And yet the top of the firm, in this case it's Lynn Doty, they don't even understand that concept. And it's funny because KPMG just had this whole controversy with 6 of their biggest auditors who didn't understand ethics. And it's these top people that, even though they're supposed to be higher level and supposed to be away from the numbers and the day-to-day, they still think in that auditor mindset. You have to think in the business purpose mindset. You have to think outside of the box. And that's a little bit of what Elizabeth Warren is saying here, in that KPMG was only thinking about how the direct fraud of setting up bank accounts would impact the financial statements. They didn't think of the bigger picture about the headline risk and the impact to Wells Fargo's stock price when all this bad news came out, when that their whole executive structure was corrupted by these individuals. They didn't do that. And Lynn Doty's response doesn't really answer that. It's more of cookie cutter legalese. And because it's this cookie cutter legalese and didn't respond in the way Elizabeth Warren wanted, she's now going over to the PCAOB and essentially telling them to do something. So KPMG did themselves no favor in this response. They essentially just shot themselves in the foot and are now passing the buck on to the PCAOB. And it's these leaders, or I would call it a lack of leaders, that make everybody else within the firm pay. Because of Lynn Doty's lack of a response, in my view, other people in the firm are now going to pay. It's going to be the partners through an equity hit. It's going to be the staff through more and more training. Even though they're not the ones that did anything wrong, it's the partners that did something wrong. The staff will have to take more training. I don't think you can regulate your way out of this. You can't pass a law. You can't tell people to take more ethics training. You have to develop it from the ground up. You have to really teach the importance of values, but not in some web-based training. You just have to show it. And if people aren't meeting that expectation, you have to dock their pay. It can't be just selling more work. You have to reward your most ethical and your highest valued people. It has to be a total systemic change. Otherwise, this is going to persist throughout the industry for years. Well, those are my thoughts on the KPMG controversy regarding Wells Fargo. I'd like to thank you for listening. And I want to remind you to share this podcast with a friend because I want to change this industry. I want to make it better. I want to make it better for all the young people that do want to work in an ethical environment, that do want to succeed based on their hard work. But I can't do that without your help, without you sharing this with a friend. So thanks again. Make sure to share this, subscribe, and review it when you get a chance. Thanks again.